I need you to hold two numbers in your head simultaneously. Not because they are interesting, not because they make for a good headline, but because the gap between these two numbers is the single most important unresolved question in the entire precious metals market right now. And the answer to that question, which number is right and which number is wrong, will determine whether the investors holding silver today are sitting on one of the greatest wealth-building opportunities of the decade, or whether they are holding a falling knife that still has a long way to fall. Number 1, $75. That is where silver is trading right now, on Sunday, May 3rd, 2026. Down 40% from the historic high of nearly $130 that this metal printed earlier in this cycle. 40%. In a market where retail investors were euphoric, where headlines were screaming about silver's historic breakout, where every precious metals channel on this platform was declaring the beginning of a new monetary era, silver gave back 40% of its peak value. That is not a dip, that is a crash. And the investors who bought anywhere near the highs are sitting on losses that are real, painful, and psychologically difficult to hold through. Number 2, $309. That is Bank of America's bull case price target for silver. Not some anonymous analyst on a Telegram channel. Not a permeable newsletter writer with nothing to lose. Bank of America, one of the largest financial institutions on earth. A firm with billions of dollars of its own capital at risk in these markets. A firm whose research desk has access to supply chain data, industrial demand forecasts, sovereign reserve flows, and derivative positioning data that most retail investors will never see. And that firm, with all of that data, with all of that analytical firepower, looked at the silver market and said $309 is still on the table. $75, $309. Someone is wrong. And today I am going to show you exactly who it is. Because the answer is not what most investors watching the chart right now think it is. The answer is buried inside 3 layers of market mechanics that the financial media does not have the patience or the expertise to explain. And those 3 layers, once you see them, change everything about how you read the $75 number on your screen today. Asian guy here, let me show you the engine, because the price is the exhaust. And the engine is telling a story that $75 is completely failing to communicate. Let me start with the crash itself, because if you do not understand the mechanics of what drove silver from $130 down to $75, you cannot properly evaluate whether Bank of America's $309 target is genius or delusion. And most investors, including many who have been in this market for years, do not actually understand what happened. They watched the chart go down and they concluded that silver went down. That is true, but it tells you nothing about why. And the why is everything. Silver's run from the low 40s to nearly $130 was one of the most explosive moves in this metal's modern history. And like every explosive move in a leveraged futures market, it attracted exactly the wrong kind of buyers in its final phase. Not industrial users locking in supply, not central banks building strategic reserves, not long-term monetary investors with a 5-year thesis and no margin exposure. The buyers who drove silver into the 120s were momentum-chasing managed money funds, algorithmic traders and speculative hedge funds that pile into a trend when the technical signals are firing and exit with equal speed when those signals reverse. These funds were not buying silver. They were buying exposure to silver's price movement through COMEX futures contracts. Leverage bets. Each position amplified by the mechanics of a margin system that requires you to maintain a minimum account balance relative to your exposure. When the price moves in your direction, your unrealized gains grow and your margin buffer expands. When the price moves against you, that buffer shrinks. And when the buffer drops below the maintenance threshold, the exchange does not call you and ask how you feel about it. It closes your position automatically. Liquidation, forced selling, into a market that is already moving against you. Now think about what happens when silver peaks at $130 and the momentum begins to stall. The first wave of managed money funds sees the technical breakdown and reduces exposure. That selling nudges the price lower. The next wave of funds sees their margin buffer shrinking and gets liquidated automatically. That liquidation adds more selling. The algorithmic systems that were long because the trend was up now flip short because the trend has reversed. And you get the cascade, a self-reinforcing avalanche of paper selling that has nothing to do with the physical reality of silver supply and demand, and everything to do with the mechanical structure of a leveraged paper market clearing its own excess. This is what drove silver from $130 to $75. not a collapse in industrial demand, not a structural reassessment of silver's monetary role, not a resolution of the supply deficit that has been building in this market for years. A paper market margin call cascade, the mechanical clearing of a leveraged long stack that had gotten ahead of itself. And here is the critical point that most investors miss entirely. When a paper market crashes for mechanical reasons rather than fundamental reasons, it does not change the fundamentals. It resets the paper positioning. The physical supply-demand picture that existed at $130 exists at $75. The structural drivers that built this bull market did not evaporate when managed money got margin called. They are still there, unchanged, waiting. Now, let me walk you through what Bank of America actually looked at when they put $309 on the table. Because a number like that does not come from optimism. It does not come from a bullish bias or a desire to generate trading volume. It comes from a supply-demand model. And the inputs to that model are the reason the number is as high as it is. Start with the supply side. Global silver mine production has been essentially flat for several years. The primary reason is structural. As I have discussed in previous videos, approximately 70% of silver production comes as a byproduct of mining other metals: copper, zinc, lead, gold. The decision to open a new mine is not made because someone wants more silver. It is made because the economics of the primary metal justify the capital expenditure, and the permitting, construction, and ramp-up timeline for a new mine is 7 to 10 years from initial decision to first production. The supply response to rising silver prices cannot arrive quickly. It cannot arrive in 1 year. It cannot arrive in 3 years. The supply curve for silver is uniquely inelastic on the upside, meaning that when demand increases sharply, the price has to do the heavy lifting to rebalance the market because supply physically cannot respond fast enough. Now look at what is happening to demand. The industrial demand picture for silver in 2026 is unlike anything this market has seen before because you have multiple simultaneous demand drivers that are each individually significant and collectively unprecedented. Solar panel manufacturing is the largest and most well documented. Every solar cell requires silver paste applied to its surface to collect and conduct the electricity generated by photons hitting the silicon. China's dominance in solar manufacturing, combined with the global green energy build-out that is accelerating rather than slowing despite the geopolitical disruptions, means that solar silver demand is not a cyclical story. It is a structural, multi-decade demand driver that gets larger every year as installed solar capacity grows globally. Layer on top of that the AI infrastructure CapEx story we covered in a recent video. $715 billion in committed spending from just 4 hyperscalers: Meta, Alphabet, Microsoft, and Amazon. Silver embedded in semiconductor manufacturing, in printed circuit boards, in thermal management systems, in the solar installations being built to power data centers. AI demand for silver is new, it is large, and it is not yet in most analyst models at the scale it deserves. And then add the monetary demand. Central banks that increased their gold reserves in Q1 2026, according to World Gold Council data, are also diversifying into silver at the institutional level. Sovereign wealth funds, family offices, and long-term institutional allocators that have been building hard asset exposure as dollar confidence erodes are treating silver as the leveraged monetary play, the asset that moves further and faster than gold when the monetary repricing accelerates. When Bank of America's analysts took all of these demand streams, modeled them against a supply curve that cannot respond for 7 to 10 years, and ran the numbers to a standard commodity supply-demand price discovery framework, they got $309. Not because they are permeables, because the arithmetic of a structural supply deficit meeting an unprecedented demand surge has a natural price resolution. And that price resolution, when supply is as constrained as silver's is, tends to be dramatic. Now, I need to address the macro environment because the bearish case for silver right now rests almost entirely on one argument. Rates are going up, not down. The Fed held at its last meeting, but 4 officials dissented hawkishly. Traders are now pricing in a rate hike in 2027 rather than cuts. And rising rates are bad for non-yielding assets like silver. That is the bear argument. And it sounds reasonable until you look at what is actually happening in the economy right now and what the historical record says about this specific macro configuration. PCE inflation just printed at 3.5%. That is the highest reading since May 2023. Core prices are accelerating, not decelerating. At the same time, Q1 GDP came in at 2%, missing the 2.2% forecast. Growth is slowing. Inflation is rising. The Federal Reserve is sitting in the middle of a stagflationary squeeze. the exact macro environment that central bank policy tools are least equipped to address. You cannot hike your way out of supply-driven inflation without crushing growth. You cannot cut your way to stronger growth without re-accelerating inflation. The Fed is trapped, and 4 of its own members are publicly saying so through their hawkish dissent. Here's what the historical record says about precious metals in stagflationary environments. The 1970s were the defining stagflation episode of the modern era. GDP growth was sluggish, inflation was persistent, the Fed was constantly behind the curve, oscillating between tightening and easing as the competing pressures of weak growth and hot inflation made every policy choice painful. During that decade, gold went from $35 to $800 per ounce. Silver went from under $2 to $50. Not because rates were falling, rates were rising through much of that period, but because inflation was rising faster than rates, meaning the real interest rate was negative. And negative real rates are the single most reliable macro driver of hard asset appreciation in the historical record. Now look at the current real rate picture. PCE at 3.5% and rising. The Fed funds rate held steady with the possibility of a hike in 2027. Even if a hike materializes, moving rates from current levels to slightly higher levels while inflation is running at 3.5% and potentially accelerating due to energy supply disruption from the Iran blockade does not produce positive real rates. It produces less negative real rates. The environment remains structurally supportive for silver, even in the hawkish scenario that the bears are citing as the reason to sell. The bear case is built on nominal rates. The bull case is built on real rates. And in a stagflationary environment driven by a geopolitical energy shock, the real rate picture does not resolve in the direction the bears are assuming. It resolves in the direction the data from the 1970s, from 2008, from every previous stagflationary episode tells us it resolves. In favor of hard assets. In favor of the metals that cannot be printed, cannot be frozen, and cannot be inflated away. Let me bring this back to the specific price level we are sitting at right now. Because $75 is not just a number on a chart, it is a battlefield, and the outcome of the battle being fought at this level right now will determine the trajectory of silver for the next 12 to 18 months. $75 has held multiple times in April. Every time silver has dipped toward this level, buyers have stepped in. Not speculative buyers chasing momentum, patient buyers, strategic buyers. The kind of buying that comes from investors and institutions that have a fundamental thesis and are using price weakness to build a position at levels they consider attractive. The $75 level has become what technical analysts call a support zone, a price range where the demand from buyers consistently absorbs the selling pressure from momentum exits and margin liquidations. Below $75, the next meaningful support levels are $72 and then $68. Those levels represent the zones where a more serious test of the bull market thesis would occur. A sustained break below $75 would not invalidate the Bank of America $309 thesis. The fundamental supply-demand picture does not change because of a technical breakdown, but it would extend the timeline and create more pain for investors positioned today before the recovery begins. Above $75, the resistance levels that silver needs to clear to confirm the next leg up are $76.20, then $80, then $88, then the psychologically critical $100 level. A break above $100 would be the signal that the paper market has fully digested the correction, that managed money has rebuilt its long exposure, and that the structural demand drivers are reasserting themselves in the price discovery mechanism. And once $100 breaks, the path to the levels that Bank of America's model identifies becomes significantly more visible to the broader institutional investor universe that has been sitting on the sidelines waiting for confirmation. Here's what the $75 support level is telling you right now. It is telling you that the buyers who understand the fundamental thesis are present and active. It is telling you that the 40% correction from $130 has not shaken out the strong hands. The investors who bought based on fundamentals and are holding through the volatility because they understand what they own and why. And it is telling you that the battle between the paper market's short-term mechanics and the physical market's long-term fundamentals is being fought at a level that, historically, represents the kind of entry point that long-term investors look back on with clarity and confidence. Let me answer the question I opened with. $75 or $309? Someone is wrong. Who is it? The market at $75 is not wrong about what silver is worth today in a paper futures market dominated by managed money that just went through a margin call cascade and is in the process of rebuilding its long exposure cautiously. In that narrow context, the COMEX paper market on Sunday, May 3rd, 2026, $75 is an accurate reflection of current positioning and short-term sentiment. But Bank of America is not making a call about where silver trades on Sunday, May 3rd, 2026. They are making a call about where silver trades when the structural supply deficit meets the unprecedented demand surge from solar, AI infrastructure, and monetary accumulation in an environment where real interest rates remain negative because inflation is running faster than the Fed can chase it. They are making a call about the destination of a journey that the $75 price is just a waypoint on. The question is not which number is right. Both numbers can be right simultaneously in different timeframes. The question is which time frame you are investing in. And that question comes down to a single, fundamental choice about how you read the current environment. If you believe that the Iran situation resolves cleanly and quickly, that energy inflation collapses, that the Fed cuts rates aggressively in 2026 and 2027, that AI capex slows dramatically, that solar deployment decelerates, and that central banks globally reverse their gold and silver accumulation programs, then $75 is expensive and the bear case makes sense. You should sell. If you believe, as the supply-demand data, the historical macro record, the central bank behavior data, and the research of one of the world's largest financial institutions suggests that the structural drivers of this silver bull market are intact, and in most cases strengthening, that the 40% correction was a paper market mechanical event rather than a fundamental reassessment, and that the real rate environment created by a stagflationary macro backdrop is the most historically reliable driver of hard asset appreciation that exists, then $75 is not a number to fear. It is a number to understand. And understanding it means recognizing that you are looking at a waypoint on a road that Bank of America's analysts, with all of their data and all of their models, believe leads to $309. The crash from 130 to 75 was real. The pain was real. The margin calls were real. But the fundamental engine that built this bull market is also real. And that engine, the supply deficit, the demand surge, the monetary repricing, the stagflationary macro backdrop, is still running. It did not stop when the paper market cascaded. It does not care that managed money got liquidated. It is building pressure the same way it was building pressure at $130. But now it is doing it from a base that is 40% lower. A base that patient, fundamentally driven investors are using to accumulate. A base that Bank of America's $309 target suggests is not a ceiling, but a checkpoint. Someone is wrong, and the data says it is not Bank of America. This is Asian guy. If this breakdown gave you a framework for reading the $75 number that the chart alone cannot give you, the mechanical history of the crash, the supply-demand math behind the $309 target, the stagflationary macro context, the support level battle happening right now, like this video and share it with one person who is watching silver at $75 and wondering whether to hold or fold. The price tells you where we are. The engine tells you where we are going. The engine is still running.